I'm about 3/4 of the way through a book, the focus of which is the significance of decision-making under conditions of radical uncertainty at the microeconomic level of the venture capitalist, at the macroeconomic level of the economic policymaker. And one of the principal themes of the book, it has to do with the economic significance of financial bubbles, and particularly of bubbles in the equity markets rather than the credit markets. The first historical observation is that they are extraordinarily prevalent, that it's almost as if wherever there is a liquid trading market, secondary market in assets, there you will find a bubble. From Holland in the 1640s to the U.S. in the end of the 1990s. There's a great history of the City of London by David Kynaston, which demonstrates that between 1815 and 1914, during the century usually called the long 19th century, every 10 years there was a stock market boom, speculative excess on the London Stock Exchange. And the range of objects of the speculation was enormous, incredibly diverse, almost random. Latin American loans after the Napoleonic War to the gold rush in South Africa at the end of the 19th century. But every once in a while, the speculators focused on fundamental technological innovation. Back in the 18th century, canal building in Holland, in Britain, in France, then railroads, twice, then electrification, then broadcasting, and of course, the internet and the development of the entire communications infrastructure to support the World Wide Web. One of the interesting questions for new economic thinking is precisely the role of speculative bubbles in enabling investments to be made that would not be made by a rational planner or an efficient market, would not be funded in an efficient market. And I will say that I think that that was touched upon in the conference. I think there was much discussion of bubbles, but most of that work, and this includes, of course, the late, magnificent work of Carmen Reinhart and Ken Rogoff on the 800 Years of Financial Folly, most of that book is actually not about the folly. It's about the consequences. And even Kindleberger's great book on manias, panics, and crashes has more to do with panics and crashes than with the manias. And I do believe, myself, that the aspect of what gets invested, what is the object of investment on the upside of the bubble, requires focus and attention as well. And I would add that if new economic thinking involves a heretical thought or two, my work as a student of John Maynard Keynes' student, Richard Kahn, who was the supervisor of my thesis, from then through 40 years of venture capital, the lesson I draw from that is that we should not lean too heavily on efficiency as a virtue of the sort of economy in which we actually live, embedded in the sort of world into which we're actually born. That rather, tolerance of waste, the ability of an economic system and the social and political system in which it's embedded to tolerate waste, to fund errors, trial and error and error and error, in order to be able to enjoy the benefits when it works, that is fundamental historically to the growth of productivity, living standards globally, and will continue to be in the future.